Hey everyone, and happy Friday. Welcome to Trader Tales with IBD. It's your host here, Alissa Coram, and joining me this week we have Mike Shell. He is President, CIO, and Portfolio Manager at Shell Capital Management. Mike, great to have you on the show.
Thanks for having me.
Thanks so much for joining me today. All right, well, on tap for the lineup today, we're going to get Mike's thoughts on current market conditions, so how he approaches handling the twists and turns in the market. Then we're going to dig a little deeper and talk about stock selection and the ideal setups. And then probably the most important part of the conversation will be about risk management and trade management. So Mike, looking forward to an informative and entertaining discussion with you today.
Sounds good.
Yeah, let's get right to it. So first, Mike, your thoughts on the market this week. If you take a step back, the last couple of weeks, we've seen this strong rally. We're now starting to pull back in a little bit, but is there a silver lining to that perhaps?
Well, when I look at the market trend, I focus, on really three things: the primary trend, volatility, whether it's volatile or quiet, and then of course valuation in the big picture. Which valuation doesn't mean much to me, with individual stocks, but when you look at a big picture, it does. So the primary trend is down, obviously, because the indexes and most stocks have dropped over 20%, but also because they're below the 200-day moving average. So the NASDAQ, the S&P 500, the equal-weighted S&P 500, the equal-weighted S&P 500 actually went above its 200-day moving average this week, but then now it's closed down below it. So overall the primary trend is down. However, this is technically a bear market, but as you said, the stocks started bottoming about mid-June, and so I actually got long stocks again. We were out for quite a while before that, and so I started buying, got stocks again in mid-June, got fully invested, and then actually sold, took profits on those positions, and then have actually bought back again about a week ago, I guess. So now and I just reduced some yesterday. So now we're positioned on the long side, but now we're seeing some pressure on the uptrend.
Right.
So looking at the volatility, I look at realized volatility versus implied volatility. So say the VIX versus the 12-month historical volatility on the S&P 500. And, the volatility is around 20% on both, historical and implied. And, so volatility is relatively high, but historically it's not all that high. So it's actually come down from where it was. And then the third thing is valuation, and that's pretty simple. I just follow the Shiller PE ratio. Valuation is not a good market, timing indicator or anything, but it just kind of gives you an idea of how high your risk level is, and in a longer term, because you're basically paying this multiple times earnings, and the Shiller ratio is extremely high relative to the past. It's the second highest it's ever been. So that just tells you that we need to focus on rowing, not selling. When the wind's blowing, you can sit back and enjoy the ride and cast the sails wide and enjoy the ride. But when the wind stops blowing, you have to get out the oars and start rowing if you want to get home. So that's kind of where we are. So, in these kind of conditions, it's going to be, this may be a prolonged bear market. So you're probably going to end up having to tactically trade each of these swings, which is what I've been doing for 25 years. So that's pretty much, in the short run, where, the index has tested the 200-day moving average. And obviously there was apparently a lot of people watching it because it literally pulled back off of it. So right now it's under pressure, and next week we'll probably find out pretty quickly, which direction it's going to go.
Exactly. Yeah, it does seem like we're at a real crossroads here. So if this is more of a prolonged bear market, we need to be tactical. Clearly, keeping an eye on these technical levels is key to take advantage of the swings in the positive direction where we can. What would get you more confident in this overall market? Is it taking out that 200-day line and living above it? What other factors would you be looking at to really start thinking, hey, maybe the worst is actually behind us and we can start getting a little bit more aggressive in this market?
Well, for me, market analysis and portfolio management are really two different things. So when I talk about the market and indexes, that's one thing. But when it comes to actually buying and selling and trading, I'm looking more granular into ETFs, options, and individual stocks. So I'm really more focused on when it comes to actual exposure. I'm more focused on the individual trends themselves, and and then like I said, I started seeing markets move down to an extreme in June. Looking at the percentage of stocks above their moving averages and all these things. And then they started trending up, and that's when I started gaining exposure again, which was like around the 20th of June. So I'm really more focused on the individual positions and what they're doing, but in order for the market to look better, yeah, I mean, when it gets above, what you have to realize, there's a lot of factors. I know I'm considered a trend follower myself, but then I also trade stocks in the Can Slim methodology, as I have for over two decades. But on the trend side of things with ETFs, I'm running trend systems and momentum systems, which are trend following primarily. What you ought to realize is the CTA trend followers, for example, and all the trend following firms. There's a lot of firms out there that use moving averages. Mm-hmm. Every time the indexes or stocks cross above those trend lines and the moving averages, more and more trend followers are adding exposure, and we actually know about what the notional exposure is. I mean, and it's, you have the potential on the bullish side, you have the potential for a few $1 billion to come into the market as it crosses above those moving averages. And a lot of trend followers are using crossovers. It could be like a 21-day versus 100-day. Some are using the 50-200 that everybody knows about. But every time the market makes a higher high and gets above those levels, you're going to have a lot of money that's been short. They're currently short. Most all of them are short right now still. Short stocks or short the indexes, but you'll see a lot of money coming in if it continues going up. So that's, there's real reasons why those levels matter, because you will see, right, billions of dollars come in. So I think, if it can hold and not, obviously not waterfall down. Today was a pretty normal day. The current true range for the S&P is about 2%, and that's about what you had. So today was pretty normal pullback. So, we still, we're really very much at an inflection point because even despite today, it being a more volatile and down day, it's still well within the normal, what you would expect. So, but yeah, I mean, as it continues moving up, it's, the market is my guide. I just follow what the market tells me. So, if it continues moving up and then we'll stay long. I mean, I'm long right now, so.
Mm-hmm. Yeah, and it sounds like you've been taking some profits into strength. Would you use perhaps a pullback to the 21-day line or a reversal to start adding more exposure, or does it, like you said, come down to those individual stocks and those individual positions, whether it's stocks or ETFs, as that to be more of your guide for adding exposure?
Much like what you guys are doing at IBD, I'm focused on, I'm watching stocks, I'm watching ETFs, and I have systems that help me do all this too. Right. And so, as long as those stocks are trending up, we're going to stay in them. And as long as they keep trending up, we're going to add to them. So, and the same for ETFs. We do a lot of sector ETFs and a very global opportunity set with ETFs. So I'm also trading, bonds and commodities and things like that using exchange traded funds, and try to, be in things that are not as correlated. Right now, most everything is pretty correlated, but try to, add exposure to things that are not necessarily connected to the trend of the stocks. But yeah, I mean, for me, it's always been an individual position decision because it's based on what those underlying stocks are doing. And when the market does fall a lot, if it goes into another waterfall decline of where it's dropping 2, 3, 4, 5% a day, multiple days, and all that, everything else is going to go with it for the most part. So as I'm flowing with the trends, it's going to either put me. And I actually did reduce exposure. Yeah, just yesterday, I reduced exposure a pretty significant amount, but it's about 16%. That's no longer that was in stocks that are not in stock. So, and I did that just based on my own portfolio risk and the relatively higher risk level of the market right now. A lot of things are overbought because we've had a real nice run up here, and I participated in it, thankfully. And so you have to be a lot more nimble in bear markets too. And this is a pretty typical bear market, and you're going to have a lot of swings up and down of 10, 15, 20%. So you have to be careful not to wait until it trends up to like this, and then you buy in only to participate in the downside again. That's what you have to be really careful of. And that's really what my edge was. And, during the 2008 crash, I did, really well during that time because I was simply trading the swings, the counter trend moves, buying oversold, selling overbought, and doing that over and over and over again all year, and probably had a 400 or 500% turnover in 2008. I'll have that again. We're probably at about 200% already this year, where we've done a lot of trades. Luckily, we trade through market makers, so we don't pay commissions to do that anymore. So we can trade. There's nothing hindering me from buying and selling as I need to.
Yeah. So utilizing that experience from 2008 and leveraging that for today, looking at some of those indicators has definitely come in handy for you. And so now let's talk a little bit more about that stock selection process. And I know that does go hand in hand with risk management, which we will definitely dive into too. But what would you say on a stock selection level are some non-negotiables for you? What are you looking for?
Well, the only non-negotiable for me is really the direction of the price trend. If something's trending up, when it comes to stocks, though, with ETFs, I'm pure price, pure momentum, pure volatility. Those are the three inputs that determine whether I'm in an ETF or not. When it comes to stocks, it's similar to that, except I do get more granular, and I pre-screen, pre-filter my stocks to make it look more like, say, the IBD 50. And I'm going to use that as an example because the reality is this is not that difficult. If the IBD 50 is already screening out the best stocks, and all you really have to do is go in there and pick which ones you like, and it could be as random as going through the list and saying, I like that name, because those stocks are already are filtered for asymmetric risk reward. I mean, they already have the earnings growth, the sales growth, and all the CAN-SLIM factors, are pretty much in there. And so, I always tell people you could throw darts at that list, and I encourage people to actually take the IBD 50 every week and throw it into a portfolio tracker and just watch and see what happens. Pretend like you bought them all, and then maybe pick your favorite 5 or 10 and just track them every week and see what happens. And you'll start to learn that most of those stocks are going to go in the right direction if the market itself is in the right, on the right state.
Yeah.
So that really is the key. As far as getting into the screening the stocks, I've done a lot of testing, and fundamental earnings growth and all that's a little more difficult to test, or at least it used to be 20 years ago when I first started doing it. Now it's much more doable, but at the end of the day, the earnings growth and sales growth and all the fundamental things, new products, all those things really matter. And it probably, for some people, it'll matter a lot because they want to sort of buy into the story. For me, that's not a big deal, but for a lot of people it is. And if that's the case, then that's what you need to do, because that's what works for you. Yeah. For me though, I think that most of those things are subsumed by the trend. Things that are trending up with strong relative strength and strong momentum, all the fundamentals are subsumed by that, meaning that that is the thing that's driving it probably. In long term, the reason that stocks go up over the long haul is simply that their sales and earnings are increasing 25, 30, 40, 50%. So if you're going to trade in stocks, you really want to have all those criteria be, so to me, I really probably rarely ever, trade a stock that's below 80 on the IBD's composite or something, those kind of measures. Or most of the stocks that I'm focused on are typically going to be on the the IBD 50. It used to be the IBD 100, but they're typically going to be those. And I think that people get too caught up sometimes in doing too much research on those things, when ultimately all you really want to do is run a quantitative screen. Because I've been doing this since the mid to late 90s. Run the screen, and there's your screen, and then you take the chart, and the pattern recognition after that, and let it rip.
There you go. Let it rip. It's what I've been wanting to get to, because we were talking about this in our little prep call. So I think that it's that portfolio management, that trade management and risk management piece that is really key, because like you said, I mean, if you know a couple of fundamental factors, that technical or momentum, screening criteria factors that you're looking for, that's one thing. But then managing that trade, that can be the most daunting part for people, especially people who are newer to this. But even traders out there who have been doing it for a while, it can be tricky because you have market conditions that can play into things, how aggressive to be, how much room do you want to give the stock, what's that stock's personality. But, with all of the, not only research, but, the battle tested strategies that you've employed, it seems like that risk management piece, having that formula really dialed in is what allows you to let it rip, or let those winners run with confidence.
Yeah. Well, and that the risk management, so everything else that we've talked about for me isn't nearly as important as risk management, because the market analysis to me which is mostly what I share on Twitter. I'm just mostly tweeting charts of indexes and things, because we can't tweet, what we're actually buying, because my firm is a registered investment advisor and, professional money manager. So we have certain rules to follow on that. But, so what I really do is focus more on the risk management. And I tell you, when I see a lot of people that, a lot of traders are indecisive about what to do. You see people that are, they'll be looking at a chart, and if it's gone down, then they'll let's wait and see how far it goes, and then buy it if it turns around. If it's gone up a lot, they'll say, well, it's overextended. And here's the reality: the way that you resolve, or the way that I resolved these issues many years ago, and what I'm known for mostly is my risk management methods and systems. And some of this is going to be, some of it is stuff that is far more widely known today than it was 10, 15, 20 years ago. But then the way that I do it, specifically the algorithms, are much more proprietary. But in the simple way of putting it is, whatever you're looking at, and we could pull some charts up and just use examples, but whatever you're looking at, whatever say a stock is at $50 a share, and you want to buy it, and say $45, so $5 below that, $45 is the price at which the trend would no longer be up. So that's number one, is at what point does the trend go down and say that you're probably wrong and too early, too late, whatever. And let's say it's $45, but the other caveat that I put in there, by the way, is average true range. What you never want to do is have an exit that is too close to the current price, and that's within the normal noise of the market. So like I said earlier, the 15-day average true range of the S&P index right now is about 2%, has been for a while. That means that you should expect it's going to move 2% daily from the high to the low would be a pretty normal thing, and it's going to normally stay within that. If you go 2 times that amount, then you're talking about 4%. So if the S&P were to gap down 4% on Monday, now that changes things. You see, if it went down 2%, well, that's still within normal as far as the volatility goes. But if it goes down 4 or more than 2%, then you're getting outside of the norm. And all of a sudden you've stepped out into a non-normal situation in the way that the price is trending, because trends are, to me, are trend, the direction, the momentum, and the volatility. And so so you want to make sure that your exit is outside of the normal noise of the market. And that is a percentage of the average true range is how I define it. You can define it lots of ways, but that's how I do it. So let's say we're buying at 50, we're going to get out at 45, and that $5 a share that we're risking is the, it's well outside the normal noise of the market. Once I determine that, then I size the position based on the percent risk of the portfolio. Now, here's where it can get a little complicated. You see, most everybody that the IBD strategy is really considered a somewhat systematic strategy in that it's following rules. However, it is discretionary. You're physically running your screen, looking at the chart, see the signal on the chart, see that it looks right, probably get a good feeling about it, and then pull the trigger. The get a good feeling about it part, by the way, is confidence, which is an emotion. You need confidence to want to pull the trigger. That's why, each person has their own stocks that they like. You got to have some level of confidence. But once you do that, then you want to take the position and let it rip. So if I had, say for $1 million account, if I had tested, we can test based on the system what percentage we ought to be risking in each position, and say it comes out to be 1%. That means that 1% is how much I'm going to risk in this $1 million portfolio. So I'm going to risk $10,000 in the position. And I don't mean I'm only going to buy $10,000 worth. What it means is I'm going to take $50 divided by 45, which is $5, and I'm going to say how many shares will it buy? Will $10,000 at risk in the portfolio level? How much would it buy of a $5 risk? So that's 2,000 shares. So 2,000 shares times 5 is $100,000. So the position would be $100,000 in the portfolio at the portfolio level. I'm only actually risking 1% though. Because I'm risking $5 a share, not 50. And so that is how much we have at risk. And then we could do that, say 10 times, 10 positions at a time. If we did that, then we'd have 5% or we'd have 10% risk at the portfolio level. So that if all those stocks, if the market got hammered the next week and all those stocks go down and they hit my exit point, you're going to lose 10%. So there's where you control your risk tolerance. And that's how we do it with our clients. Our position size determines how much drawdown we can control for our clients based on their risk tolerance level. So it's all about, it's really about drawdown control. And if you think that if somebody don't want more than, say, a 20% drawdown in their portfolio, then you're not going to be risking 10% at a time. Because remember, once you get out, you got to get back in too, which means you got to open up some more risk. So you have a risk bucket or a risk budget, some call it. And if you want to control your drawdowns to say 20% maximum, then you would only want to use certain percentages of your risk along the way. Because if this, and this is where I ended up having a very low drawdown in 2008, what drawdown we did have when we were underwater. And that is because I was, risking certain amounts at a time, and I was prepared for what I believed, just like now, looked like it was going to be maybe a prolonged bear market. So when we're in a prolonged bear market, then I'm scaling everything back. And I don't mean I'm tightening my stops. A lot of times, like I said earlier, tight stops will mean you'll get busted out of the position a lot more often. You have a lot more small losers. And that works with aggressive trading, but you're just going to, you got to be willing and able to do that. So once you get in the position, then, you let it rip. And I mean, I literally, when I take the position, I've already decided I'm going to lose 1% of the portfolio to see if this is going to play out. You know, that's really what you're saying, and you have to truly accept that amount that you're going to lose 1% of your portfolio to see if the stock is going to go up, or ETF, whatever it is. And that's what gives you the ability to let it rip, because you accept that, you know, I just consider it's already gone. I mean, you know, for me, once I've gotten in that position, it's like, you know, if I have to close it out at a loss at 45 and lose 1% of my equity, that was completely acceptable, because I determined that in advance. But here's the really big part where I think
Okay.
I think what's really critical is once you get underway, and now imagine you have to do this with every position, so it does
Mm-hmm.
require software. You know, you're going to need Excel or something. I have developed a program that I use, but uh, once you get in a position, then say it goes from 50 to 60. But if my exit is still at 45, now I'm risking $15 per share. So
Mm-hmm.
my risk level, it changes the portfolio heat, which is how much I have at risk in that position. It has now been, you know, it's gone up. So you raise the exit as you go. And of course, ideally, I want to be risking profits more than I want to risk principal. So
Mm-hmm.
ideally, I want to get that exit up above the $50 mark, so that in that position, you're, you know, if we were to raise it up to 55 now, and the position's at 60, still only risking $5, which
Mm-hmm.
is a smaller percentage at risk at the trade level, because you're on the $60 stop. So you can see how, as things unfold, you raise your exits, and you're doing that across all the positions. So there, whether it's 5 or 10 or 15 positions, I'm doing that across all of them, and so I know what the whole portfolio heat is in terms of drawdown. And if all those positions get hit, here's how much we would lose, and I'm able to control and manage that. And by the way, sure, somebody say, well, what do you do when the stock gaps down and, you know, it goes far below where your exit was? Well, yeah, that does
Right.
happen. It's all built in. You see, when you're testing this, and whether you're testing it based on hypothetical testing of a system using, you know, quantitative, you know, programs to back test, or whether you're just testing using your own historical trades, because I've been doing the same thing over and over again for nearly 25 years. I mean, it's the same process over and over
Yeah.
again. I've got a lot of trades I could go back and, you know, look at without even a simulation, and see, should I be betting more or less, and, you know, should I be risking 1%, or maybe a half of a percent, or more. And that's basically calculus. But
Mm-hmm.
that really is the key, is what you do once it's underway.
Yes.
Now, and if you have any, you know, an example you want me to show you, but let's say, you know, as it keeps going up, or then
How
trends
about,
down.
I have an idea. How about something like Enphase? I mean, that's the leader in the solar area, and that's seen quite a move since its earnings report. It did come in a little on Friday, but what about something like this? Say the buy was on that move on earnings. How does this
Well,
example?
my exit on that would be for sure where that gap is under. So it's kind of a high top flag, except it's arched. So right where that top gap is, right, yeah, right below there, right in there. I think if it went below where that gap is, you've probably got a change in dynamics.
Mm-hmm.
And so I would for sure, that I'd have an exit right there. I wouldn't want it to go below that, because then when it fills that gap, you know, it's probably more likely to keep filling it. So so and so whether I was buying it, because, you know, I might be willing to buy this a position in this now. If I were, I would, right there would be my stop. There's my risk. I would make sure though that was, you know, probably about 2 times its normal true range, to
Mm-hmm.
make sure that I'm not too tight, because then I'm just going to get stopped out and waste money. So I want
Right.
to make sure that the stop is some multiple times its normal range. But, you know, but right there, if it goes in a stock like that, if it goes below that, around that level, you're pretty likely going to get into a different, you know, regime, a different dynamic for the stock. because normally I think it'll probably, it's gapped up into a whole new level, so it's created a whole new island of price action there, and it looks like it's all-time high. Yeah, so so your last high is way back 2 years, year ago. So that doesn't really there's if there are people that bought a lot of it, and I do see there's a dark blue bar down there. If there's probably people back there that maybe took new positions around that level, and that's probably what's causing that churning of of it kind of it's hit a little bit of resistance where there's somebody back there at that prior high, somewhere in that range, probably. And it's a year back. That's but I'd say institutions and a lot of individuals. I think individuals probably tend to hold on to stocks too long. They don't they don't manage their stocks because it is it's a full-time job really, and
yeah.
So they probably hold on to losers more. But that's probably what you're seeing right there. So yeah, I would actually be concerned if it filled that gap and went below, and maybe even put it at the high of that blue bar, that big gap up day. Probably to give it a little more room, I'd probably go about right there. And that way, if it closed down below that, then I think I would go ahead and want to step aside and see what happens from there, because now you've gone from this more or less a big long base for months of just swinging up and down, and now you're pulling back down into that. So
right. Yeah.
Now let me make a comment on this though. Let's look at this. So let's call it 300 and 250 for simplicity of the math. Let's say it's at 300 now. It's close, and let's say that the exit line's at 250. So I'd be risking, if I were buying it right now, which will dovetail into whether I'm holding it right now. If I were buying it right now, I would, I'd put my exit in. I'm risking $50, okay, on a $300 stock. So how much of a distance, the more distance to your exit point using percentage risk, the more distance to your exit point, the smaller the position you're going to be in. Does that make sense?
Yep.
Because and it might be simpler to go back to my original example. Earlier I said $50, $45 exit, risking $5. Let's say $50, $40 exit because it's really volatile. Because or maybe $40 exit because there's a lot of distance between where it is and where you would want to get out. Well, your position is going to be cut in half.
Yep.
Because you're risking 1% on $10 a share, which gives you, you're at $1,000 of a $50 stock. So you got a $50,000 position in $1 million account. You see, so now your total position has gone down from 10% down to 5%.
Yeah.
So you're taking half the position. That's how. When you hear somebody say, well, it's too extended, or maybe it's too extended, it looks great, but it's awfully extended. I don't actually do that pulling back, wait for the pullback kind of thing much. I go ahead and size the position using my algorithm that I described in simple terms, and I let it rip, and I'm just in a smaller position by default. And I'll tell you something else that I don't do much is I don't scale in. I know I did the Can Slim certification thing back in like 2005, 15 years ago, or however long. And the scaling in and pyramiding thing, I don't do that as much based on just for the sake of doing it. I do it based on how my risk looks.
Yeah.
So for example, if I had bought that stock in that prior line that you drew where it was breaking out for the first time, my exit point might have been all the way down there, at some much lower level. It might have been, I might have been given it 10% or so to go down. Whereas like right now, if you take a new position in it, it may only be 5% away from where I said I would raise my stop, my exit to. You see what I mean? So the more room you give it, the smaller the position you're going to have. So that's why I say, rather than worried about extended positions, I go ahead and take the position. My position algorithm automatically factors that in. It takes care of my concern for it being so high, so far away from where I'm going to get out. It alleviates that because it just simply automatically puts me in a smaller position. So I ended up picking those positions and letting it rip. I take those positions and then I follow it after that. And then if it moves up, I may, if the position moves up, then I may be, raise it, and I may end up with a bigger position just because of how the trend itself is unfolding. Because what I care about is the price action of the trend and its volatility, which is simply how quickly and how far prices spread out. Volatility is how fast and how far prices spread out. So volatility contracts and then it expands. And so the money management algorithm will actually, when you're doing it right, it will actually alleviate most of the indecisive things that I see people,
Right.
A lot of times people are indecisive about things.
Oh, I think my internet cut out a little bit. I'm so sorry there. Finish your thought.
No, I was just saying for me, my portfolio management system, the percent risk and all that is what prevents me from being indecisive is, I'm just naturally going to have smaller positions in the ones that look like they've made that higher run. So, and I started doing that back, it's been 20 years ago, probably 2004, 2005 or something like that. I've been using IBD for over 2 decades and I had daily graphs, before it was Market Smith and like when I would see the high top flags or whatever, I just end up having small, if it's moving up, I have a smaller position and that's what really controls it. And that alleviates, and I've helped a lot of other, professional money managers and stuff along the way. And that this tends to be the one thing that alleviates a lot of people's indecisiveness.
Yeah. Well, Mike, I know we were just scratching the surface with you, but it was so great to pick your brain. You have such amazing experience as a money manager, doing such great things. And we really appreciate you taking the time today to sharing not just general concepts, but really getting into the nitty gritty of not only how you view the market, select stocks, manage positions, but that portfolio management piece as well, I think is so important for investors. So thank you so much for your time today. Really appreciate it.
You're welcome. Glad I could do it.
It was great. All right. Well, we'll have to have you back. Thank you so much for watching, everyone. We hope you have a great weekend, and we'll catch you back here next week.